Good morning. Today I'm in a mobile home community in California, and this one is very special. It is a co-op park, right? Co-op stands for cooperative, and that means that it is not quite a rental park, and it is not quite a land-owned park. It's a little bit of both, and that is actually a very good thing, but it also can be a very bad thing. So, in this video, I'm going to break down the difference and why it matters, so that if you're looking for a home in California and you come across a co-op community like this one, you'll know the difference and why it matters. Okay, so I'm back in the studio and I'm eager to get to the bottom of what is so important about a co-op park, and especially why, if you're looking at buying a mobile or manufactured home in California, you might run into a various type of park: rental park, land-owned park, or in the middle, co-op park. And why is a co-op park something very important that you need to know ahead of time before you buy? So we're going to go through it right now on the video, okay? So 3 ways a mobile home community can be set up. I just mentioned them. We'll go through it. So there's a rental park, and a land-owned community, and a co-op park. And again, today I'm focused on the third one, the co-op. It feels like a step up from renting, and in some ways it is. But the financing can actually be worse than what you would consider to be a regular rental park loan. It can actually be worse. And nobody explains that at the time when you're looking at buying. So the first type is the most common. That's the rental park. That's where an individual or company owns the park itself. It's a business, and usually they own the land underneath it too. And the resident, you come in and you want to buy a house there. So the resident would own the home itself, the structure, as personal property, and rents or leases the space it sits on. This requires a residency approval and qualifying to live there. And the resident can vary, rents can vary from lot to lot. So in a rental park, the once the space turns over, usually management will raise it a little bit more than normal. So every year you get a little annual increase on the rent. But if the home has sold, you can have an extra bump upon sale. So what that means is that if you're in a rental park and you're looking at one home, right next to it could be an exact same year and same price and everything, but the rent might be significantly different. So watch out for that. The second type is a land-owned community, and that's where the resident owns the lot, the dirt, and the home together. All right, so that removes the risk of a rent increase, like I mentioned in the rental park. You own the land and you're a resident just like everybody else. This is usually run as an HOA with a resident board, which is you typically volunteer, and often a property management company will handle the day-to-day work. But legally, this is structured as a condominium and sometimes a PUD. And the difference is that the board, the residents who own their individual lots, are going to decide based on the economics of running the park how much their HOA dues will be. You don't want it too small or too big for obvious reasons. All right? Now, the third type, and the point of the video, is the co-op park. So a co-op park is a private corporation that owns the park and usually the land too. It's private, so it's owned by the residents that live there. So when you buy into a co-op park, you are buying the structure, the house, but you're also buying the share in the corporation that owns that slice of the corporation. Okay, you own a slice of the corporation, and through that you own the land. Okay, but it's that little difference that makes all the difference. What's going on in the co-op park is that a resident has a personal property structure on a leased space, and your lease is with all the other residents. So they can't come and kick you off your space, even though they own some of your space too. And you can't force somebody off their space because just because you happen to own a little bit of their space. So you own everything collectively in one level, but then you own individually on another level. So you can see how kind of complicated that actually turns out to be. So the part that's genuinely true about a co-op is that residents do get a say. Their monthly dues are set by the people living there, not dictated by a landlord. And no single owner can raise the rent whenever they feel like it, the way a rental mobile home rental park would possibly have that. And a lot of them are under rent control, so they can't just willy-nilly raise rents. But you do have that bump, and that's really where a co-op park is the advantage. Okay, you do get an ownership, true ownership share. But here's the surprising part. Even though a co-op resident would own the piece of the corporation, the loan is still, a lender is going to still give you a personal property loan, a chattel loan. And that's like the same thing as a car or a boat or a regular mobile home in a mobile home park. Now, why is that the case? Well, because the land itself is never pledged as collateral. You don't pledge the share, you don't pledge the land. Now, when it comes to a lender having to collect if somebody doesn't pay, that's where it becomes interesting, which is why a lot of lenders won't lend there. But the land is never pledged as collateral, and this is where a lot of the co-op residents get blindsided. They don't understand that. Okay, so I get a lot of calls. It seems like all the time, but it's very frequent that a co-op resident will call and they may have seen a house or a condo loan advertised at a really low rate. And they call up and they say, hey, I live in this co-op community. I own the land. Why can't I get a low rate? And I have to tell them, well, it's because you don't have a house or a condo. You have a mobile home or a manufactured home in a co-op community, which is just not the same thing. And so this applies to not only a low rate on a real estate loan, but it also applies to a second mortgage or a HELOC or even a reverse mortgage. So, the corporation share that a resident owns doesn't change how the lender will classify the collateral. So that's really where you need to be aware of what's going on. So a chattel loan versus real estate loan, the actual difference is a real estate loan is secured by the land and the structure together. So if you pull the home off and you take it to, the desert, it's not worth anything or hardly anything, right? You could stick it on a piece of dirt and call it home, and it might be great for you, but it's not worth as much as if it's in the co-op community where you bought it. And alternatively, if you remove the home and you just have the space, you can't do anything with it, right? It's just a piece of dirt. You can't set up a tent. They won't let you. So you need the home and the land together, whether that's a leased space or a co-op space or a condo PUD space in a land-owned park. They're important to go together, right? So a chattel loan is just the structure, right? As opposed to real property connected with both. So the chattel financing costs more in real ways. The loan terms are typically shorter. You're going to often find 20 years instead of a standard 30 in real estate. Now, there are some mobile and manufactured home lenders that will go to 30 years, like I do, but they are few and far between, and they are adjustable. Okay, interest rates are typically higher. We're talking 2 to 5% higher compared to a regular real estate loan. And ultimately, if you're buying in a co-op park, your options for loans is much smaller. There are some co-op parks where no lenders will lend there. Others, it's just one lender, and then some maybe have two options. But you got to just take what you get, which is the downside. So you want to be aware of that going into it, right? So even a longtime resident that owns and lives in a co-op park is not exactly aware and is maybe a little confused about what it is they actually own. So, is the share collateral for the loan? And is the share part of the purchase price that I'm buying? And the share is usually valued as a specific amount, and that's pegged to a fixed value that might not move for years, where the market value of the home is going to move constantly with the regular general market of residential housing. So if it's in demand, the market's going up, your value will go up too. Your the cost to buy will go up too. And that's really what confuses people is that if you ask the park on a co-op park, they're going to say, "Oh, the share is worth 200,000," and the price is actually is like 400,000, and you're thinking, well, so the home is worth 200,000 because it's 2 plus 2 is 4, and that's not necessarily how that all works. If you were to separate them, they become the values become wonky. But if they're together, that's where the magic happens, like I said. So here's what this adds up to in actual practice. No second lien position loans. So if you're going to buy them in a co-op park, do not expect a second position loan, even though you technically own the land. And there's no HELOC, no second mortgage, and no reverse mortgages. So if you're ever thinking about that, that's not going to happen. So the honest truth, honest reason this doesn't come up during the sale is that people they don't want to risk losing the deal, right? So an agent or a lender, they're really probably not going to really force this point. Although they may mention it, it's not really advertised as that kind of a warning to the buyers because they don't want to lose the deal. So you should be aware of it. That's just why the point of the video. And buyers are, typically got a lot on their plate. They're trying to figure out how they're going to pay for it, how they're going to move, how they're going to come up with a down payment, and can they afford all of that. So they're not really thinking about years ahead of refinancing or pulling out cash. They may not understand it, or think about that while they're trying to buy. So this is why the anger shows up later, not just at closing. Years down the road, somebody wants to do something like that, and they all of a sudden think, "Oh, whoops, what did I buy?" And they get angry, unfortunately. So don't let that happen to you. So a co-op ownership is real where it counts. You get control over your community and your dues, your monthly payment. So that's great, right? And they're typically sell at a premium because of that. They usually are very well run because of that as well. But when it comes to the financing, it buys you nothing when you're sitting at your lender's desk. The fix isn't to avoid co-op, it's to know what you're getting when you're going into the purchase, not years later when you're looking to refinance. So if you're thinking about buying in a co-op park, you want to watch my other video. It's why banks won't finance your mobile home in a park, and then who actually will. So look for that. It's coming up next. Thanks.